Okay, my name is Bobby Vaught. This is lesson 13 in the series Everything You Need to Know to Understand Investing. Don't forget to hit the subscribe button so when lesson 14 comes out, which will be Wednesday about the September 4th, 2024. So if you're subscribed, you'll know exactly when it comes out, okay? I will put a link in the description below to lesson 1. So if you're new to this channel, it makes it very easy to find it. Just go back to the beginning and just go through everything, okay? And then in addition to that, each lesson has a link to the next lesson in the description, so they're all very easy to find. Okay, so today we're going to talk about how to trade around a position. If you watch the financial news sometimes and you hear one of those analysts, they talk about, well, I'm using this stock or this security, whatever it is, to trade around a position. This is what they're referring to. Trading around a position can be done with anything where, one, there's price fluctuations, which is pretty much everything, and where you don't have a penalty for early withdrawals. It's obviously not going to work well for you if you have a penalty for early withdrawals. Okay, so, and you'll understand why in just a second. So, in other words, it wouldn't work with CDs or something, for example. It's got to be something where there's price fluctuations, which is pretty much everything. It can be a stock, it can be an ETF, it can be an index fund, some other mutual fund, anything where there's price fluctuations, all right? Okay, so here's how it works. Has potential to add small gains to your portfolio. Everybody's heard the term buy low and sell high. Now that makes sense, that's reasonable. Here's the problem. How do you know what that is? Nobody really knows. I'll explain what I mean. You buy XYZ stock at $100 per share and you've held it for a while and now it's at 130 maybe. Yeah, you could sell and realize a gain, and you certainly sold higher than what you bought it. That's good, but 130 is high relative to what? Here's what I mean. We don't know the future. Nobody knows. It could go higher. We analyze stocks, and we're going to get deeper into analyzing stocks and making not guesses, but educated guesses based upon information. Okay, there's a difference. It's not just blind guessing. It's educated guesses based on information. But in any event, you own it. You own XYZ stock. It went from $100 to $130. Well, what if you sold and then it goes to 150? You could have sold at 150. Likewise, you bought it at $100 per share. What if it goes down to 95? Well, maybe you want to buy more. A good company just got less expensive, but that first initial purchase could have been at $95 instead of 100. I don't try to time the markets. Just find good companies and buy them. Just find good companies and own them. I'll tell you a short story before we continue on trading around a position. This happened to me roughly about, I'm going to say about 11 years ago. I was watching the financial news. I don't even have television service anymore. I don't bother with it. But in any event, I was watching the financial news, and there was a stock, I don't remember what it was, not really material to the story here, but there was a stock that I was looking at. I didn't own it yet. I was looking at it and considering making a purchase, and sure enough, somebody on the financial news happens to mention this same company at whatever price it was. It's 11 years ago. There's a couple of details I'm not going to be able to recall. So it happens to mention the same company. But that same analyst said, but wait a couple of weeks and buy it on a price dip. We think it's going to go down before it goes back up. I thought, okay, I'll wait. So I waited. And here's what happened. It didn't dip. It went up. And I hadn't bought yet. So I was sitting there looking at it thinking, well, I could have just bought at the better price when I first thought of it. That's why I don't try to time markets. I don't try to time, you know, and I don't do that. Just find a good company and buy it, okay? Find good companies and own them. And keep investing, you know, down to what works. If you want to exercise something like a strategy called trading around a position, it takes a little bit of time, a little bit of effort, because you may have to make a trade every day. And I'm not real big on trading every day, but I'm going to explain how to trade around a position just in case it's something you want to do. This is getting into some very advanced investing techniques, okay? All right. So anything where there's a price fluctuation, and let's just say a stock, you know, XYZ stock, whatever. So you're gonna have to start with a certain number of shares, like let's say 1,000 shares perhaps, or 500 shares, whatever. Let's say 1,000 shares so we can do the math easy. And it's going to need to be something that you feel very comfortable with based on the other analysis, things that we covered in lesson 2, 3, all the previous lessons, something you feel very comfortable with. It's going to go up over time, okay, regardless of the short-term fluctuations. So let's just say you start with you start with a certain amount, let's say 1,000 shares, okay? And now you can do this daily or you can do it weekly. If you do it less often than that, it kind of gets a little bit pointless, but let's say you did this daily. So you look at the price 5 minutes before closing time, 5 minutes before the market's closed. If it went up that day, you sell 10 shares. If it went down that day, you buy 10 shares. Okay? And some people can get really and then every day you just keep doing that. Some people can get really intricate with their trade around a position strategies. Like, for example, they'll say, instead of just 10 shares, I'm going to say 10 shares, and in addition to that, another share for each 1/10 of a percentage point gain or loss. So, for example, if it went up, so you bought it at, let's say $100 per share, okay? So you bought $100 per share, and let's say it went up 0.7% on the first day after you first bought it and you own it. It went up 0.7%. That happens, 0.7%. So instead of selling 10 shares in this more intricate strategy, you would sell 17 shares, 10 plus those 0.7% increments. Okay, you'd sell 17 shares. Next day it goes down 0.4%. Instead of just buying 10 shares, you would buy 14 shares. Make sense? You don't have to get that intricate with it if you don't want to. That's fine. If you just want to keep it a little simpler and say, I'm going to buy 10 shares every time it goes down, and I'm going to sell 10 shares every time it goes up, that's fine. Whatever number of shares it is. You could say 5, 10, you know, whatever. Okay, so here's the small disadvantage. Here's a disadvantage to trading around a position. When you first bought those 1,000 shares, you're going to need to leave some cash sitting on the sidelines, so there's an opportunity cost there. That's cash that could have been invested in something else, or just more shares of the same stock. But oftentimes there's nothing really wrong with having some cash sitting on the sidelines ready to go so you can take advantage of opportunities. And in this case, you're trading around a position. You need some cash sitting on the sidelines, because what happens if you buy 1,000 shares and then it goes down every day for the next 5 days? And according to your trade around a position strategy, you feel compelled to buy 10 shares, or whatever amount is you're trading, to buy 10 shares for the next 5 days. Well, obviously you're going to need some cash sitting on the sidelines to do that, okay? Here's the advantage to trading around a position. If we just graph this out and think of this, here's a y-axis, think of that as price, and here's an price, and here's an x-axis, think of that as time. Okay, so at times zero, your first day, you bought 1,000 shares. Next day it goes up, so you sell 10 shares. Next day it goes down. You bought 10 shares and it goes up. You sell 10 shares and it goes up again. You sell 10 shares and it goes down. You buy 10 shares, et cetera, et cetera. If you think of those in pairs, each buy and sell like a pair, okay? So that means that for every buy, there is at least one higher sell. And for every sell, there's at least one lower buy. Buy low, sell high, right? For every buy, there's at least one higher sell. For every sell, there's at least one lower buy. That does not mean that every buy is lower than every sell, or that every sell is higher than every buy. I mean, think about it. It can go here, and then 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 here. Okay? It does not mean that for every that every buy is lower than every sell, or that every sell is higher than every buy. It just means that for each buy, there is at least, over a period of time, for each buy, there would be at least one higher sell, and for each sell, there would be at least one lower buy. And the difference between those two things, between those, is cash in your account. It's just cash added to your account. Okay? It's called trading around a position. Okay, I hope I explained that well. So if you're watching the financial news and you hear somebody use that phrase, trading around a position, that's what they're referring to. It can be done with anything where there's price fluctuations and where there's no penalty for early withdrawal. Okay. So I kept trying to keep that kind of short. That's lesson 13. I was about to say it's Sunday night. It's actually early Monday morning now. I'm very late making this lesson. I said I was going to do it on Saturday, and now it's 12:20 in the morning, Monday morning, September 1st. So on Sunday. So that's lesson 13. Hope you got something out of that. We've got a lot more to cover. And cover just basic terminology. We need to cover basic terminology like trading around a position, some other things we've covered before, because in future lessons those terms may come up. Okay? All right. So hope you got something out of that. It's not a strategy that you really have to do if you don't want to make your investing that intricate, okay? But it is a choice. If it's something that sounds like you would want to do, great. And over a period of time, it has potential to add small gains to your portfolio. All right, so that's lesson 13. Lesson 14 will come out on Wednesday, September 4th, 2024. And don't forget to hit the subscribe button. You'll know exactly when it hits. If you're subscribed, and you'll get a message. And other than that, I hope life is treating you well. And see you Wednesday.